Hello everyone and welcome back to another episode. I'm your host, the Millennial Investor, and in today's episode we are going over a company that makes up currently 4% of my portfolio, and it is now going to be making up 5% of my portfolio because I just increased my position in it. This company is finally experiencing a little bit of a downturn. It's currently down about 5% on the day, and I'm going to go over why in this video, why it continues to remain one of my top positions, why I'm increasing in my portfolio, and why this company has such an advantage over the basic brick and mortar retail. When we look at companies, like let's go to the research tab here, and let's click stocks, and let's sort by the largest market cap companies. And the third largest company in the world right now is Amazon. And usually you hear this story of Amazon that, oh, Amazon is going to come in and they're going to bankrupt all the old brick and mortar retail stores. All the old traditional physical stores that are in place are no longer going to be able to thrive just because of Amazon. Amazon Web Services is taking over these smaller companies. And while there is some merit to the story, it is not 100% true. I will show you some companies like the one we're talking about today. Home Depot's 5-year performance on a money-weighted return is up 149%. Let's look at other retailers that are doing good. Let's look at Nike. Nike on a 5-year return is up 139% on a money-weighted return. Let's look at others. Let's look at a new kid on the block. Let's look at something like a Lululemon. They're just a basic clothing brand, nothing special about them. They're one of the best performers in the market. Just 5 years ago, this was a $60 stock. Now it's in the 300s. You're looking at a 400% money-weighted return in a 5-year span. Now, when we look at a company like Amazon and it's dominating the space and getting rid of these brick and mortar retail, what it's doing is that it's not eliminating all retail whatsoever. It is just eliminating some of the bad performers. Now, let's look at a company like, for example, that owns a lot of these bad brick and mortar retails. Let's look at something like ticker symbol SKT, a Tanger Factory Outlets. Its 5-year performance, well, it speaks for itself. It owns a lot of these old-timey stores that don't really fit in with today's business model. Or the same thing with something like SPG, Simon Property Group. They own a lot of basic shopping malls out there. They're the largest owner of shopping malls on earth, and you can see, once again, its 5-year performance as well. So when you look at this doesn't mean that Amazon is ever going to take over a company like Home Depot. And to prove this, we're going to go over in this video why this company is set up better than ever for the future. We're going to look at the earnings that they just came out with, the dividend increase they just announced. We're going to look at the fiscal year earnings for 2017, 2018, and 2019. And we'll even go back to comparison to look at some of the numbers for this company that it produced going back to the Great Recession in 2009, 2010, and 2011 as it got to the back half of the recession as we started to recover. But before we get all that into this video, guys, I appreciate you for tuning in. My name is Jordan. I'm the Millennial Investor. If you're not familiar with me, I'm a dividend growth investor, and I currently own 23 different companies listed in column A right here that I'm highlighting. And I track my annual and monthly dividend income through these two charts right here. And I also track my portfolio value and even disclose my monthly YouTube as well. And this should be getting updated in about a week or so stay tuned for that. These are my 5 investing goals for 2021, and my 2021 stock market prediction is in there as well. And if you like the brokerage that I'm going to be using in this video, the brokerage that I'm showing you right now on the screen, all throughout my videos, you'll see me using the same brokerage, M1 Finance. It's absolutely free. It's incredible to use. It has so many great features, and I love all of what it has to offer. And we go over here and we click refer and earn, and when you realize that when you download this link and you deposit $100 to the platform, you will get $30 just for getting signed up. $30 just to download, just to sign up. That's all you got to do and deposit $100. We've had 96 people. We're finally about to cross triple digits. Be the 100th person to sign up using my referral link. I would really appreciate it. You would help support the channel, and more importantly, you'd get to use a brokerage that has some incredible investing platforms, and I would really appreciate it if you go ahead and do that. So check that down below in the description. There's lots of other things as well, including my investing pie if you want to invest in it or look at it yourself firsthand. This is right here. This is also down below in the description, including auto savings accounts, credit card referrals, mentoring calls, lots of other things like that. So check out the description down below, and let's go ahead and get started with Home Depot. Now, right now, Home Depot is having a big down day because of the earnings that they just came out with, and let's look at the earnings for Home Depot. The top article here on CNBC today says Home Depot tops estimates as sales surge 25%, but shares fall on worries pandemic gains won't last. Now, let's look at the numbers real quick and see how this company did compared to what analysts were expecting. Earnings per share, $2.65 versus $2.62 expected, a small earnings beat. Revenue, $32.26 billion versus $30.73 billion expected, a pretty decent beat there. So they beat on revenue. They beat on earnings, and I think the one reason why this company is going down is that they did not issue guidance for 2021. The company is still a little bit uncertain with the whole COVID-19 pandemic, and they're not sure how to guess what this company will produce in revenue and earnings per share going into 2021. But here's what's funny here. The company beat on revenue. The company beat on earnings. The company is doing great. It's putting up record numbers, and the stock is going down. Right now, it's currently down 4%. Earlier when I looked at this before I started this video, at one point it was actually down 6% on the day, so a massive downturn. And the funny thing is that if you look on Yahoo Finance, analysts are actually expecting this company to produce 5% increase in earnings per share next year, which is what I want to see as a dividend investor. And they're looking at fall on worries that the pandemic gains won't last. Let's go ahead and skip forward, and I want to pull up some numbers that I went all the way back a decade in the past, okay? And the reason why I want to pull up these numbers is because I want to show what this company did after a recession, okay? Because the 2008-2009 recession was one of the worst times economically speaking that this country has ever seen. And so if there was ever a time like where a company like Home Depot should struggle, it's 2008, 2009, 2010, 11, 12. During that 3, 4, 5-year period when we're in a massive downturn and things are slowly starting to recover because employment was very high, things were very difficult, especially for a big home retailer like Home Depot. So this is when a company like Home Depot should really be struggling. But let's look at the numbers here. So first of all, let's look at sales. These numbers are in millions, by the way. So remember when you see 71,000, that's actually 71.2 billion. So in 2009, during the bottom of the stock market, they produced $71.2 billion. Now further past that, just because the stock market bottomed in 2009, unemployment kept on going down up into 2010, 2011. So let's see how they did after that. They went from 71.2 billion to 66 billion, a little drop off there, and trended back upwards a little bit towards 68. So you can see on a 3-year period, which once again, this is one of the worst times to be investing in Home Depot, that they just barely downtrended in sales. Now for me as a dividend investor, I always talk about the most important thing for me as a dividend investor. The most important thing for me as an investor in these companies is earnings. I want to see a company that has cash flow. I would rather invest in a company that does 10 billion in profits but only 15 billion in revenue than a company that does 100 billion in revenue, $1 billion in profit. And that's because I focus on the profitability of a company, its cash flow. What can the company produce in earnings so that way it can pay back dividends, it can buy back its own shares, it can do capital expenditures, it can pay down debt. The more earnings you have, the better. And while revenue is obviously important, the earnings for me is what is most important as an investor. Now when you look at their sales and you see that they downtrend a little bit over the last 3 years during this time period where things were very poor, let's go ahead and look at their operating income. 4.3 billion up to 4.8 up to 5.8, a steady uptrend. And if we look at their basics earnings per share right here, they did $1.34 in 2009 up to $1.58 in 2010, and then a massive uproar in 2011 of $2.03. And this is once again back when this company was during the worst time in the economy. Its profitability is skyrocketing. Even though their revenues weren't quite as high as they were during this period, this is okay, they still had mass profitability. And this is great when a company like this, when it hits a downturn, can switch its opportunities from seeking massive growth opportunities, switch to more of a profitability stage so they can protect themselves in a downturn. And that is why a company like Home Depot is a lot more defensive in these type of cyclical markets than a lot of people give it credit for. Now let's go ahead and look at what they announced this morning. They did just announce their fiscal year 2020 results. Now if we look here, they're doing much better numbers now than what we were looking at back in 2010 and such. But in 2020, they did just produce $32.3 billion, which is much higher than what we were looking at, an increase of $6.5 billion from the previous year, or in other words, a 25.1% growth rate from the previous year, fiscal 2019. Now, obviously, this is a unique situation where the pandemic shut things down, people were spending more time at home, and they spent a lot more money at Home Depot. Net earnings for the fourth quarter were $2.9 billion, or in other words, $2.65 in earnings per share. So they finished out the year in fiscal year 2020. If we scroll down right here, they finished the year with net earnings of earnings per share of $11.94, almost $12. Now their previous payout was $6 a year annually because they paid out $1.50 every single quarter right here, and then they paid out $6 a year, and they nearly doubled that. they paid $11.94. So that means that they only paid out right at about half of their earnings in 2020. And going into 2021, they're expecting an increase in earnings per share as well. And this is why they just announced a massive dividend raise. If you look here, the company today announced that its board of directors approved an increase in its quarterly dividend by 10% to $1.65, which equates to an annual dividend of $6.60. This is during the worst times. Remember, this is during economic recessions, right? This company is not raising its dividend 2%, 3%, 4%. This company is raising its dividend 10% in the double digits. So when you look at a company like this, it's downtrending from great earnings. It has a massive dividend increase, and now after today's news with increasing that dividend, now has a good dividend yield and still has lots of room to grow. I think that this is an opportunity for me to increase my position in Home Depot, which I will likely be doing this week. I intend on doing it actually this week. I'm just looking for a company to take down because I always talk in the past how me as an investor, I really find it hard to take any money away from any of these companies because I'm so bullish on them. But I'm going to pick one to go down 1% at least so I can bump up Home Depot because it really needs to be bought during this downtrend. Those of you that watch me and follow me on the channel know that I like to buy my companies on a downtrend, and now's the time to be buying Home Depot. That is not financial advice, that is just strictly my personal opinion, and I'll be buying Home Depot probably very heavily going into 2021. And last but not least, let's look at the numbers for 2017, 2018, and 2019, okay? I want to show the numbers before 2020 because obviously this was a very unique situation. It made Home Depot perform much better in 2020 than a lot of people expected. So let's take that out of the picture. How was this company doing beforehand? 2017, 2018, 2019 earnings. I want to see how the company did then. So let's look at the growth rates first. In 2017, the company grew 6.8%. We're talking about just regular revenue, regular sales. They grew almost 7%. In 2018, they grew an additional 5%. In 2019, they grew an additional 3.5%. And let's look at their transactions increasing as well. 2% increase in transaction, 1% increase in transaction, 1.1% increase in transaction. But their average ticket, meaning each transaction, what it was worth, not only did they do more in transactions, but the transactions were heavier as well, meaning each time they went to the store, if last year they spent an average of $100, then next year they spent an average of $104 or whatever the case may be. In 2017, they did a 4.5% increase, 4.2 in 2018, 2.5 in 2019. And you can see the transactions, average ticket, diluting earnings per share all went up. And let's go ahead and look at the net sales for 2017, 2018, and 2019. $100 billion in 2017, $108 billion in 2018, $110 billion in 2019. Now let's scroll down and let's look at the net earnings. Net earnings, once again, $8.6 billion. 11.1 billion, 11.2 billion. Keep on increasing. Let's scroll up here and let's go to the earnings per share because once again, profitability, that's what I talk about. I look at the earnings per share. That's what's most important to me as an investor. In fiscal year 2017, they did 7.29. The next year, they jumped up massively, up to 9.73, and then once again a steady increase in 2019 up to 10.25. And it's a company like this that continues to find ways to increase value to shareholders. That's why they have this thing called the value wheel. If we look at it right here, they have their values wheel, which outlines all their main bullet points, not only as an investor, but basically the values that Home Depot stands behind. And one of those is creating shareholder value, and that is what I'm focusing on as an investor in Home Depot. So I'm increasing my position in them. It's not one that I'm afraid of, any type of pandemic or any type of news, what might be going on with Amazon or any type of other online retailer trying to take over Home Depot. This is a dominant company with really only one competitor, and that's Lowe's. And when you look at an oligopoly, which once again, Lowe's is a great company to invest in as well, but when you look at an oligopoly like Lowe's and Home Depot, it's hard to imagine a scenario where either one of these two companies go bankrupt. I expect both of them, especially the one that I'm investing in, Home Depot, to be an incredible brand, an incredible investor staple, and I expect this company to continue to have massive profitability, revenue growth, and the adaptive way that this company's executive team handles things. I think that they're able to adapt to really any changes that happen in the market or the economy over the next decade. But I'll be investing heavily in Home Depot over these next couple months. If it continues to downtrend, if it goes under, say, something like $250 a share, I'll start buying even heavier. And especially if it goes down to the low 200s, then I'll be really, really attractive. But thank you guys so much for watching. And I'd really appreciate if you guys were able to use that referral link if you'd like to do so. This link, once again, down in the description. You get $30 for just signing up. Just download M1 Finance and deposit $100 to the platform. But thank you guys so much, and I'll catch you guys next time.